Hey guys, welcome back to the channel. Today I wanted to talk about investing in something that's maybe a little less exciting than the equity markets, and that is the bond markets. We're talking about fixed income. The two terms are used interchangeably, and we call it fixed income because that's what it basically provides. It provides you a steady fixed income with interest payments on these bonds. So what a bond is a promise from one person or entity to another. When they borrow money from you, they're going to pay you back that money, plus they're going to pay you interest payments over the period of time which they're borrowing that money. So it's a good way to get a regular interest payment over time with very little risk, at least relative to the equity markets. Now, of course, bonds still come with their own risks, and different bonds have different risk levels. One of the major risks is that the person borrowing the money can default. But the more secure that entity is, say like the US government, the less likely they will be to default on those. So in this video, I'm going to go over a few ways to invest in bonds. The way I'm going to do that is by looking at bond funds. And in particular, I'm going to be looking at a few of Vanguard's ETFs. And so I'm going to be talking about different types of bond funds, including US government bonds, and I'll go into long-term bonds, intermediate bonds, and short-term bonds. I'm going to be talking about international bond funds. I'm going to be talking about corporate bond funds, and I'm going to be talking about municipal bond funds. And that should give you a pretty broad overview of the sort of classic types of bonds you can invest in. So first off, why would you want to invest in bonds? If you're looking for an investment that's not focused as much on growth, but more on steady income, say you're about to retire, or you're just looking to level out the amount of income that you get throughout the year, bonds can be a really nice addition to your portfolio. On top of that, it does give you some amount of diversification. For anyone who's younger, I generally suggest that you don't put too much money into bonds. But if you are looking for just some amount of diversification in case the equity markets turn down, having some amount of bonds is good so that you can reallocate your portfolio and rebalance. Let's start by talking about government bonds. And there are three sort of major ETFs that Vanguard offers. And those three funds are Vanguard's long-term, intermediate term, and short-term treasury ETFs. So let's start by looking at Vanguard's long-term treasury ETF. That's VGLT. And as of now, in November of 2024, the yield is 4.55%. And this is a great fund because it's pretty low, has a pretty low expense ratio. Just as a quick overview on this bond fund, it basically seeks to provide a high and sustainable level of current income, and it invests primarily in US Treasuries with an average maturity between 10 and 25 years. So when we're talking about long term, that's what we're talking about, 10 to 25 years. And so when we're talking about long-term treasuries, it means that we're locking in an interest rate over a longer period of time. There is interest rate susceptibility. So if the interest rates rise over time, that means that you're getting less than what you can get at the current market level. But if they fall, then you've locked in a higher rate. The longer the bond, the more susceptible it is to interest rate changes. Because if you think about it, if you have a short-term bond that you can get out in 1 year, you're not fixing in your money for very long. So there's less risk to interest changes. So if we look at some of the characteristics of this portfolio, we'll see that it doesn't hold a ton of bonds, but right now the number of bonds is 86. And this is a passively managed fund. It's benchmarked against an index. But we can see that the average coupon is 3.1% and the average duration is about 15 years. If we look at their underlying holdings, we'll see that it has various coupons at different rates. And they're all US Treasury notes. So there will be a number of different interest rates at different lengths of time. Having some amount of long-term treasuries can be good just to fix the amount that your interest payments are going to be. So as we move to more intermediate bonds, we can look at Vanguard's intermediate treasury ETF, and that is VGIT. The yield on the intermediate bond fund is slightly lower at 4.13%. And again, this intermediate fund basically does the same thing as it invests in US Treasury bonds, but their weighted average maturity is about 5 to 10 years, so a little bit shorter than a long-term fund. And we can see there's a slightly higher number of bonds in this, 107 right now, and the average coupon is 2.9%, with an average duration of 5 years. So again, similar investment strategy. The goal is obviously to create fixed income, but the interest rate is slightly lower with an intermediate fund because interest rates have come down. And if we look at the holdings again, we can see that there are varying coupon rates, but they're all U.S. Treasuries. And the maturity dates also vary from 5 to 10 years, basically. Finally, let's look at Vanguard Short-Term Treasury ETF, which is VGSH. Now, this has a 4.17% yield. And again, this seeks to provide current income with, some modest amount of fluctuation and invest in U.S. Treasury bonds. Now, the dollar-weighted average maturity is 1 to 3 years here. So it's a lot shorter than the long-term Treasury fund. This will probably end up being closer to whatever interest rates are at the time because of the shorter duration. The average coupon here is 2.8%, and the average duration is 1.9 years. Looking at a U.S. Treasury fund, anywhere from short-term to long-term, you're going to get a pretty low-risk investment with some amount of guaranteed fixed income. If you're looking to keep interest rates as close to what they are at the time, you want to invest in shorter term treasuries. But if you're looking to fix the payment that you're going to get, you can look at longer term treasuries. Another thing to know about investing in bond funds is that unlike investing in the bond itself, you're not actually buying the bond outright. So the bond fund just buys a number of bonds underlying. And so the price will fluctuate of the bond fund as interest rates change. So in some ways, you're still being affected by interest rates, but you're just buying into a whole basket of bonds. The next type of bond fund I'm going to talk about is international bond funds. And so Vanguard has a few different types of bond funds. And the three that I'm going to talk about are their Emerging Markets Government Bond Fund, the Total International Bond Fund, and the Total World Bond Fund. The Vanguard Emerging Markets Government Bond Fund is VWOB, and the SEC yield right now is 6.28%, so it's much higher than your typical government bond. This is because it comes with more risk. So it's investing in emerging markets governments. So this is going to be, different countries that are doing the same thing as the US, but carry more risk because their economies are less stable. And we can see that VWOB holds a little under 800 bonds, and they're, investing in different countries. So we can see that based just on their sort of the top holdings, that they invest in Argentina, they invest in Mexico, they invest in Qatar. So these are the typical types of countries that you'll see in these bond funds. Again, there's a higher risk that there will be defaults on these bond payments, but because they're government, they're a bit more secure than other promissory notes. But the reason that there's a higher yield again is because these governments have to pay a higher yield to get people interested to buy their bond funds because it carries more risk. One thing to note about this bond fund is it has a slightly higher expense ratio at 0.2%. So that's one thing to keep in mind. The next two bond funds I'm going to talk about are the Vanguard Total World Bond Fund and the Vanguard Total International Bond Fund. Now, these two invest again in international markets, and BNDW, the Total World Bond Fund, invests in global investment grade bonds. So these aren't just government bonds, but they could also be corporate bonds as well. And the ETF holds a good number of bonds. So right now it's at 18,000 bonds with an average coupon of 3% and an average duration of 6.6 years. And we can see that there's exposure in different places, and the majority being in North America, in Europe. So it's investing across the world. including the US. And talking about the Vanguard Total International Bond ETF, BNDX, we're looking at a bond fund that invests in everything outside of the US. So, it's majority in Europe, somewhere in the Pacific, some amount of emerging markets, a little in North America and the Middle East. Again, these are looking at, if we look at the holdings, we're looking at the UK, France, Spain, Italy. And so these are oftentimes like government bonds from other countries that are more developed, but it still includes some amount of emerging markets. And the yield on this is like slightly lower, 2.86%, with a lower expense ratio than the emerging markets fund. So this would help you get some exposure to sort of like international markets. So the next type of bond I'm going to talk about is a corporate bond. So in the same way that governments can borrow money from people to pay for things, corporations can do the same. So if they want to invest in stuff, they can issue a corporate bond and people can purchase that bond. So the Vanguard ETF is VCLT, Vanguard Long-Term Corporate Bond ETF. And currently the yield is 5.48%. Now, this is a nice bond fund because it's a pretty low expense ratio at 0.04%. And this invests in, investment grade bonds that are issued by corporations, and it maintains an average maturity of 10 to 25 years. There will be interest rate sensitivity, but you're getting this from corporations who tend to have a higher yield than the government. And this bond fund holds about 3,000 bonds with an average coupon of 4.7% and an average duration of 12.9 years. The majority of the credit ratings are, anywhere from AAA to BBB, so they are higher grade bonds, but they do take on, a slightly lower tier of those higher tiered bonds. And we can see that, some of their holdings are companies that you've heard of before, like Anheuser-Busch, CVS, Pfizer, Goldman Sachs. So they're very solid companies, and so you can expect that they have a high likelihood to repay those bonds. So the risk is fairly low when it comes to investing in this long-term corporate bond fund, because they're just investing in blue chip stocks and companies that have been around for a very long time. Okay, so the next group of bonds I'm going to talk about, I've sort of mentioned before, they're municipal bonds. So municipal bonds are also government bonds that are issued by either state or local governments in order to finance different projects. And the great thing about municipal bonds is they offer some amount of tax advantages. This just means that when you go to pay your taxes, they're not going to tax you on the interest that you gain, depending on where you live. There's obviously a strategy to optimize where you're paying income taxes. So if you're, a California resident, you most likely want to buy a California municipal bond so that you can optimize how much you save in taxes. The tax-exempt funds that Vanguard offers is VTEB, Vanguard Tax-Exempt Bond ETF, and it has a very low expense ratio at 0.05%, with a yield of 3.46%. The yields are obviously not as high as other bond funds, but again, this offers some amount of tax advantage. Now, this bond fund, VTEB, holds over 10,000 bonds with an average coupon rate of 4.4% and an average duration of 6.5 years. And this is investing in all sorts of municipal bonds, including like a Los Angeles bond, California bond, Texas bond, Maryland bond. So these will offer you some tax advantages depending on what state you live in, but it will depend on sort of where you file your income taxes. Fortunately for anyone living in California, there is a Vanguard Total California Tax-Exempt Bond Fund, VTEC, with a yield of 3.15%. And this purchases bonds inside California. So if you're paying state taxes in California, this could be a nice addition to your portfolio. Again, this will offer you regular fixed income and also help you save some money on taxes at the end of the year. So I hope that was helpful. Generally speaking, I would say like investing in a low cost bond fund is the best way to approach investing in fixed income. This will give you some regular amount of interest payments month to month with a small amount of risk in comparison to purchasing equities. And having some small portion of your portfolio in bonds will help you diversify. So again, just to recap, fixed income or bonds are used as a lower risk investment with regular income payments. So if you're looking for, some sort of steady income, it might be a good idea to have some amount of fixed income in your portfolio.